If you have a mortgage and your lender escrows for taxes and insurance, each year they do an escrow analysis. If you want to understand what the document explains and what changes it proposes, stay tuned for my explanation. Each year, it's unavoidable. Taxes and insurance seem to keep going up and up year after year. And if you're escrowing each month, although you may have a fixed monthly payment for your principal and interest or mortgage payment, the mortgage payment that you make on a monthly basis still changes. Taxes and insurance keep going up, and therefore your lender must collect more into the escrow account to keep up with its payments that it must make to the city and to your insurance agency. For most cities and towns, at least here in Massachusetts, the common practice, because taxes are so high, is that they are billed on a quarterly basis, meaning you have a partial tax payment every 3 months, and then summed up together in an annual basis, you've paid it in 4 payments. Homeowners insurance, or hazard insurance as it is known, is typically paid as a lump sum full annual payment. Since the lender is escrowing on a monthly basis, they simply prefer to pay the full renewal premium as it is due, and then you only have to worry about that once a year. If you do not escrow for taxes and if you do not escrow for insurance, then you yourself are personally responsible for making those payments directly to the city or town or directly to the insurance company. Let's take a look at sample escrow analysis statements so that we can review what proposed changes the lender had on these statements. Before you is an annual escrow statement from Flagstar Bank, a previous mortgage I had on my property. The statements, when you receive them, are usually issued at least 60 days before the expected change date. So I received this back in November, and they proposed a new payment effective January 1st. Moving forward to the bottom of the statement, you can quickly see that my old mortgage statement had escrow amount of $413.84. Principal and interest remains the same. The monthly payment was $18.29 with 2 sets. Now, the projected new payment changed my escrow account to $438.18, and that was a result of my escrow account being short. Why was it short? It was short simply because my taxes and insurance had gone up. The lender always proposes 2 choices. Option number 1 is to simply make a lump sum payment into the escrow account, here in this case $437.62, and although it will reduce the escrow shortage, your monthly payment will still increase because every future month must account for the new mortgage payments and the new higher escrow that needs to be taken into account to keep up with the current mortgage and tax payments. On the other hand, if you choose not to make a lump sum payment, option 2 states that the payment will be $1415.18, principal and interest never changes, the new escrow monthly amount $437.62, and then that shortage, which was analyzed by the bank, is $36.52, and the new payment will be $18.89. I took the option of making the lump sum payment, but the payments still increased just slightly. Here you get a breakdown of what the homeowners and taxes are for the year. An escrow amount is simply homeowners and taxes insurance added together and then divided by 12. In this case, my property taxes were $4,139.42. My insurance was $1112. The sum of those fees divided by 12 resulted in the $437.62. When calculating your mortgage payment, the lenders are always required to maintain a minimum 100% escrow payments, and they generally collect roughly 20% extra. They do not want to take the risk that if the payments went up slightly, they have to go back to you to get that shortage. They simply project a slight increase over time. Here, the lender has provided an analysis of what the projected tax payments are over the next year. Each quarter, every 3 months, 1,051, 1,051, 1,018, 1,018, and then homeowners insurance, 1,112. The projections are always based on the current year with the anticipation that they could change. Now that's based on property taxes and homeowners insurance history of whether they in fact increase or not over time. The statement further has actual disbursements that occurred and projected disbursements. Actual means your actual loan history in the past, and projected simply means this is what we anticipate to pay in the future. The lender at the end of each monthly statement will provide a description or explanation of how to make sense to all of this. But year to year, as you get more experience in dealing with your lender and making your payments, it should all come together and make sense. It's important you keep track so that you know that homeowners and taxes are paid currently each year as they are due. I hope you found my video helpful. Thank you for watching.